All right, let's dive right in. Today, we are going to absolutely master a core accounting concept you have to know to crush your exams and, for your actual career. We're talking about the lower of cost and net realizable value. Ready? Let's do this. So, let's kick things off with a big question. You, as a future CPA, you're looking at a company's balance sheet. You see that big number next to inventory. But is that number telling you the whole truth? Is that what that stuff is really worth, like right now? Well, the answer comes from this fundamental accounting idea called conservatism. Think of it as the accountant's motto: hope for the best, but prepare for the worst. It's all about being realistic, even a little pessimistic. It basically says, hey, don't you dare overstate how much your stuff is worth, and if you think you're going to lose money on something, you need to recognize that loss now, not later. And that leads us straight to the problem with just using cost. See, when a company buys or makes inventory, they record it at what it costs them, the historical cost. But the thing is, the world changes. And sometimes what you paid for something in the past is way more than what you could sell it for today. So why does this happen? Oh, for a ton of reasons. Maybe some of the goods got damaged in the warehouse, or more likely, they just became obsolete. Like having a warehouse full of iPhone 4s when the iPhone 15 is out. Sometimes the market just tanks, or maybe, oops, the product has a design flaw and nobody actually wants it. All of these things drag the value down. So to keep companies from, lying on their financial statements, the rulebook, specifically International Accounting Standard 2 or IAS 2, lays down the law. It's super clear. You cannot, under any circumstances, carry inventory on your books for more than you actually expect to sell it for. Period. Okay, so how do we follow that law? Well, that brings us to the hero of our story today, the LCNRV Golden Rule. I know lower of cost and net realizable value is a bit of a mouthful, so we just say LCNRV. Let's break down what that really means. And here it is. It's so simple, but it's incredibly powerful. You just look at two numbers, what the inventory originally cost you and this thing called net realizable value. And then you pick the one that's lower. That's it. That's the whole game. Okay, cost, that's easy. We know what we paid. But what in the world is this net realizable value? Well, think of it as the special tool we need to use to figure out the true current value. And once you know how to use this tool, you've pretty much mastered this whole concept. Now, don't let the official definition here scare you off. All it's really asking is, if we sold this item right now, how much cash would we actually pocket at the end of the day? It's not just the price tag. It's the price tag minus all the annoying little costs you have to pay just to get it sold. It's literally a simple three-step recipe. First, you start with the selling price. Easy. Then you subtract any cost you still have to spend to get the product finished. Maybe it needs packaging or something. And finally, you subtract all the costs it'll take to actually make the sale happen. Let's put some real numbers on this. Say you've got an item you plan to sell for $100. But wait, it still needs $5 worth of packaging. And you'll have to pay the salesperson a $15 commission. So 100 minus 5 minus 15. Your net realizable value is actually only $80. That's the true cash value. And now, for the moment of truth. We apply the golden rule. Our item originally cost us $85 to make, but we just calculated that its NRV is only $80. So, which number do we use? The lower one. We have to report it at $80. We just took a $5 loss, and that is conservatism in action. Okay, now let's get into the tricky part. This is the detail that trips up a lot of students, but if you can nail this, you're going to be way ahead of the curve come exam time. So, the formula seems pretty straightforward, right? But that last little piece, costs necessary to make the sale, is kind of sneaky. This is where the real exam-level questions come from. What do we actually get to include in there? So here it is, the number one trap. Most people think, oh, that just means costs like a sales commission, something that only happens if I make the sale. But that is wrong. The IFRS Interpretations Committee, basically the rule police, has been super clear that you have to include all the costs that are necessary. And you don't have to take my word for it. Here it is, straight from the source. The official guidance says you're not allowed to limit the costs to just the incremental ones. Why? Because if you did, you'd be ignoring other real costs of selling, which would make the inventory's value look higher than it really is. So what does this actually mean in practice? It means you have to use your judgment and think bigger.
You need to allocate a fair portion of things like your sales team's salaries, or if you're running a big marketing campaign for that specific product, a piece of that campaign cost has to be included too.
Okay, whoa, that was a lot. So let's lock all this information into your brain. Think of this next part as your personal study hack, a cheat sheet designed to make this stuff stick with you all the way to the LCPA. First up, always remember the big why. Why do we do any of this? One word, conservatism. The whole point is to keep it real and never ever make your assets look more valuable than they truly are.
Second, you need to tattoo this formula on your brain. Seriously, it's your #1 tool for any inventory problem. Selling price minus cost to complete minus, and this is key, all costs to sell. Don't forget that all. And here it is, your ultimate LECPA cheat sheet. The rule, pick the lower number. The tool, the NRV formula. The trap, costs to sell means everything. The purpose, conservatism. And hey, here's a little pro tip for you. Under IFRS, if the value of that inventory bounces back later, you can actually reverse the write-down. If you can remember these 5 points, you are ready for whatever the exam throws at you. So I'll leave you with this thought. The next time you're looking at a company's financial statements, don't just see inventory and move on. Now you know the story behind that number. You have the power to look deeper, to ask the right questions, and to really understand if that company is being realistic about its financial health.